As investors, we all strive to find profitable investment opportunities, but where do we look for them? As Seth Klarman, a legendary value investor, points out, investors are constantly processing information, yet they often spend their time analyzing fairly priced securities with no special interest. So, how do we find those undervalued investment opportunities?
Hello and welcome to today's video, where we'll be discussing the topic of where to look for attractive investment opportunities. Our discussion will be based on Chapter 9 of the book, Margin of Safety by Seth Klarman. In this video, we'll explore 5 key areas that can help us identify such opportunities. Part 1. Where to look for attractive investment opportunities. Part 2. Market inefficiencies and institutional constraints. Part 3. Insider buying and management stock options can signal opportunity. Part 4. Value investing and contrarian thinking. Part 5. How much research and analysis are sufficient?
According to Seth Klarman, value investing encompasses a number of specialized investment niches that can be divided into 3 categories. 1. Securities selling at a discount to breakup or liquidation value. 2. Rate of return situations. 3. Asset conversion opportunities.
First, let's talk about securities selling at a discount to breakup or liquidation value. One technique to identify these stocks is computer screening. However, keep in mind that databases can sometimes be out of date or inaccurate. So, it's crucial to verify the information before making any decisions. By double-checking the data, you'll ensure that you're making informed investment choices based on accurate information.
A second category of attractive value investments is rate of return situations, which includes risk arbitrage and complex securities. These investments have known exit prices and approximate timeframes, allowing investors to calculate expected rates of return. Mergers, tender offers, and other risk arbitrage transactions are widely reported in financial publications like the Wall Street Journal and the New York Times business section, as well as specialized newsletters and periodicals. Finding information on complex securities can be a bit more challenging. However, they often come into existence as byproducts of risk arbitrage transactions. So, by keeping an eye on those, you may discover valuable complex securities as well.
A third category of investment opportunities includes asset conversions, which involve distressed and bankrupt securities, corporate recapitalizations, and exchange offers. In these cases, investors' existing holdings are exchanged for one or more new securities. Distressed and bankrupt businesses can often be found in the financial press, as well as through specialized publications and research services. You can obtain fundamental information about these companies from published financial statements and, in the case of bankruptcies, from court documents. Keep in mind that price quotations for these securities might only be available from dealers, as many are not listed on any exchange. To identify corporate recapitalizations and exchange offers, maybe need to closely read the daily financial press. For additional details on these extraordinary corporate transactions, check out publicly available filings with the SEC.
Finally, many undervalued securities don't fit into any of the specialized categories we've mentioned above. To find these hidden gems, there's no substitute for good old-fashioned hard work. However, there are strategies to improve your chances of discovering mispriced securities. For instance, examining the Wall Street Journal's leading percentage decline in new low lists can occasionally reveal out-of-favor investment ideas. Another opportunity arises when a company eliminates its dividend, as its shares may fall to unduly depressed levels. Additionally, a company's annual and quarterly financial statements, filed on Forms 10-K and 10-Q, are available from the SEC, and often from the reporting company as well. Sometimes an attractive investment niche emerges in which numerous opportunities develop over time. When you identify such a niche, consider analyzing all companies within that category to pinpoint undervalued opportunities. Specialized newsletters and industry periodicals can be excellent sources of information for uncovering these niche opportunities.
In summary, there are 5 main sources of information for finding investment opportunities. 1. Computer screening. 2. Financial press, including daily newspapers or periodicals, like the Wall Street Journal and the New York Times. 3. Newsletters and research services. 4. SEC filings, like 10-K and 10-Q. 5. Others, court documents, industry periodicals, specialized publications.
When you discover an apparent bargain, your research task doesn't end there. It's crucial to determine why the bargain has become available. For example, if in 2023 you stumbled upon a beautiful modern 5-bedroom house in a desirable neighborhood at 60% of its market value, your first thought should be, what could be the issue with this property? Instead of immediately thinking, this is an incredible deal.
The same healthy skepticism applies to the stock market. When you find a bargain, make sure to inspect and re-inspect it for possible flaws. It might be cheap due to irrational or indifferent selling, but there could be more fundamental reasons behind the depressed price. Watch out for hidden issues like contingent liabilities, pending litigation, or upcoming competition. By thoroughly investigating potential investments, you'll minimize risks and make more informed decisions.
Klarman writes, when the reason for the undervaluation can be clearly identified, it becomes an even better investment because the outcome is more predictable. By way of example, the legal constraint that prevents some institutional investors from purchasing low-priced spin-offs is one possible explanation for undervaluation. Such reasons give investors some comfort that the price is not depressed for an undisclosed fundamental business reason.
We can find some similar situations. 1. Restrictions on holding stocks below a certain market capitalization, leading to the neglect of smaller companies. 2. Constraints on holding stocks with low credit ratings, causing undervaluation of lower-rated bonds or companies in financial distress. 3. Limitations on the percentage of a single stock held in a portfolio, which may force institutions to sell when they would otherwise prefer to hold or buy more. 4. Short-term performance pressures, causing institutions to focus on short-term gains and overlook long-term value opportunities. 5. Inability or unwillingness to invest in illiquid or thinly traded securities, leading to the neglect of potentially undervalued assets.
Generally, no one understands a business and its prospects better than its management. So when corporate insiders invest their own money alongside shareholders by purchasing stock in the open market, investors should take note. Klarman writes, it is often said on Wall Street that there are many reasons why an insider might sell a stock. Need for cash to pay taxes, expenses, etc. But there is only one reason for buying. To keep an eye on insider buying and selling, investors can turn to various specialized publications. For instance, Vickers Stock Research is one such resource that can help you monitor these important market activities.
Some companies offer incentives to their management through stock option plans and related mechanisms, encouraging them to focus on increasing the company's share price. Though management doesn't control a company's stock price directly, it can significantly influence the gap between share price and underlying value, and over time affect the value itself. For instance, if management were incentivized to maximize share price, they might take steps like spin-offs, recapitalizations, or asset sales to narrow the gap between the share price and underlying value. Share repurchases on the open market could also boost the share price while increasing the underlying value of remaining shares. As investors, it's essential to be aware of management's motivations in the companies you invest in, as these can greatly impact your investment's performance. Value investing is inherently contrarian. Popular securities are often overvalued, while out-of-favor securities might be undervalued. Popular securities have already been driven up in price based on optimistic expectations, making it unlikely for them to represent overlooked value. Value can be found in securities that the herd is selling, unaware of, or ignoring. Obscure or newly created securities may also become undervalued.
But, as Klarman wrote, investors may find it difficult to act as contrarians, for they can never be certain whether or when they will be proven correct. Since they are acting against the crowd, contrarians are almost always initially wrong, and likely for a time to suffer paper losses. Not only are contrarians initially wrong, they may be wrong more often and for longer periods than others, because market trends can continue long past any limits warranted by underlying value.
It's important to recognize that holding a contrary opinion isn't always useful. If the majority's view doesn't influence the outcome, there's no advantage in going against the tide. For example, the consensus that the sun will rise tomorrow doesn't affect the actual outcome, so there's no reason to challenge this belief. it only becomes advantageous when the majority opinion influences the outcome or the odds.
Some investors strive for perfect knowledge about their potential investments, researching companies exhaustively to gather every possible detail. While diligence is commendable, there are two drawbacks. First, complete information is impossible to achieve. Investors must learn to make decisions with less than perfect knowledge. Second, even if an investor knew all the facts, it doesn't guarantee profits. This isn't to undermine the value of fundamental analysis. It's undoubtedly useful. But what truly matters is the ability to distinguish between what's important and what's just insignificant details. Klarman wrote, "Investment research is the process of reducing large piles of information to manageable ones, distilling the investment wheat from the chaff. There is, needless to say, a lot of chaff and very little wheat."
It's important to remember that the research process itself doesn't generate profits. Profits come later, sometimes much later, when the undervaluation discovered during research translates into smart investment choices that the market eventually recognizes. There might not always be an immediate buying opportunity. Research conducted today could pave the way for opportunities that arise tomorrow. Just as a great sales team relies on quality products from the factory, a successful investment strategy depends on continuous, high-quality research.
That concludes our discussion of Chapter 9 of Margin of Safety. We hope you found this video informative and valuable. Remember, investing is a journey that requires continuous learning, analysis, and application. Don't forget to subscribe to our channel to stay updated on our future discussions of value investing. Thank you for watching.